I'll have to start again because I did not start the recording. The recording has now been started, so let's just go back there. So we said we are going to do question 2 of last year's formal test 2, the one that you can find under content, assessments from or prior year assessments. So it is on Blackboard, the complete paper with a memorandum. But we are just going to focus on question 2 for our class today because we've already done a thorough question on the share capital part. So now we are going to look at the taxation part. So we are going to look at question 2, which counts for 7 marks, and a little bit later we're also going to look at question 3, which deals with the income tax part. This question 2 deals with dividends tax and capital gains tax. So in question 2, they say refer to paragraph 3 of the additional information in question 1, and then what is required of us, assuming a dividends tax rate of 20%, provide the journal entry at the 31st of December 2018 to reflect the correct balances payable to the preference shareholders and the revenue service respectively. Now, Mr. Borman always draws a very nice timeline. I'm not so good with that, but it is a very handy thing to do. But as you can see there, we are dealing with a financial year that is into 2018. We'll see when the financial year ends soon. But we know that this event takes place on the 31st of December 2018. Now, even though we're going to focus on questions 2 and 3, clearly there they refer us to paragraph 3 of the additional information in question 1. So we'll have to have a look at some part of question 1 as well. So in question 1, they said Garfield Limited, a company in the manufacturing industry, has provided you with the following account balances extracted from their general ledger as at the 1st of January 2018. So we see there we had ordinary share capital. Remember, that is the 1st of January 2018. So that is clearly at the beginning of a financial year. So ordinary share capital of 800,000 rands, 10% redeemable preference share capital of 500,000 rands. There was a revaluation surplus of 185,000 rands already at the beginning of the year. So at some point prior to this financial year, a revaluation had already taken place. And then we had retained earnings of 699,000 rands, and we know that represents the profits that we have accumulated over the years. Then they referred us in question 2 to paragraph 3 of the additional information. And that paragraph 3 we've got there, they say on the 30th of December 2018, the directors of Garfield Limited, now we've seen just a little while ago, that is the name of our company, declared a preference dividend on all preference shares in issue. Payment of the dividend will be made after the financial year end. And at that stage, they said ignore dividends tax for now because we're going to do it in question 2. The reason why we have to look at that is before we can do this paragraph 2.1, where we have to calculate the dividends tax, we first must see how we would have calculated the preference dividend and also how we would have recorded that. Okay, right, ladies and gentlemen. Now I want to see how awake and how sharp you are this morning. So you can either answer me in person by unmuting your microphone, or you can type answers in the text box or the chat box there. So if we are talking about a preference dividend, and we've seen that the name of this account that contains the balance of the preference share capital is called 10% redeemable preference share capital. What is the important thing here? The number of shares in issue or the value of the shares in issue? You can either say it or just type number or value. Number or value. Type, type, type. I see nothing in the chat box. Number or value? There we go, Anil. Some more answers. Value. Thank you, Rasmus. Okay, so when they are talking about a percentage, in this case 10%, we know that the important thing is the value. Now, we've already seen that this balance is at the 1st of January 2018, and that this declaration of the dividend takes place right at the end of the year. So that means this dividend is going to be declared for a full year. So how can we calculate this? How are we going to calculate the value of our dividend? Tap for me quickly there. What multiplied by what? Students, tap. 500,000, the value, you've already mentioned the important thing is the value. So 500,000 is the value multiplied by the 10%, right? The 10%, that is our coupon rate or dividend rate. So clearly the dividend that we are going to be declaring would be to the value of 50,000 rands. Now, I am very, very disappointed with how few students are answering here. You must type now quicker. So if we are going to declare a dividend, which account are we going to debit? Type. Thank you, Lorenzo. I see you've got the amount there for 500,000 times 1. Which account are we going to debit? We are declaring a dividend, a preference dividend. Type. Where are you, Anil? Where are you, Erasmus? Lorenzo? Which account are we going to debit? We're going to debit let me just have a look again. I see somebody. Preference dividends. There we go, Lorenzo. Thank you. I see you had your morning coffee. There, Mr. Borman also helped. There you go, Millicent. Thank you very much. So we're going to debit preference dividends. Which account are we going to credit? Remember, we are declaring a dividend. They said we're only going to be paying it after the year end. So now we must raise a liability. A liability towards whom? There we go, Millicent. You are quick. Okay, you've had your morning coffee as well. Strong coffee. Preference, shareholders. The liability is towards our shareholders. Thanks, Erasmus. Thanks, Mrs. Moore, for responding there. We are going to raise the liability towards our shareholders. So let's have a look what that journal entry is going to look like. I've just displayed it in blue here. There we go. So on the 30th of December 2018, we would have debited preference dividend, as you've said. We would have raised the liability towards the preference shareholders. They represent the liability. And the amount, as we've said, 50,000 rands. And how do we calculate that? It is 500,000 rands, the value of the shares in issue, multiplied by the coupon rate or dividend rate of 5%. And in the case of preference dividends, it works almost like interest. It's going to be a portion for that part of the year during which those shares were in issue. And we've already seen those shares were in issue throughout the year. The balance was already there on the 1st of January 2018. And we declared it right at the end of the year, the 30th of December of that same year. So it is for a full year. Okay. So from the company's perspective, ladies and gentlemen, from the company's perspective, you can again type there for me quickly. What is the dividend that we have declared from our perspective, our company, Garfield Limited? What is the amount that we are going to show or disclose as a dividend distribution under retained earnings in our statement of changes in equity? What would that amount be? Type for me there. From our perspective, what is the dividend that we've declared? Type. Don't be shy. From our perspective, the dividend that we've declared, there we go. It's not a trick question. There we go, Anil. Thank you, Millicent. 50,000 rands. Right. So from our perspective, we have declared a dividend of 50,000 rand. So that is the distribution of our retained earnings. However, bearing in mind that there is such an animal such as dividend tax. We've just seen it. Let me scroll up there. We've now got to go and calculate and record the dividend tax. Seeing that there is something like dividend tax, are the shareholders going to get the full amount of 500,000? Yes or no? Just type yes or no. Are they going to be receiving the full the full 50,000 rands? Yes or no? No, they're not. No, they're not. No, 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 they are not. You're correct, Millicent, Erasmus, and Kovile. Right, they're not going to receive the full amount because a portion of that amount is going to be withheld from them. Why do we withhold that portion? It is because it represents the dividend tax, and that dividend tax we must withhold, as I said, and then pay it over on behalf of the shareholders to the revenue service. So therefore, ladies and gentlemen, let's start maybe with one side of the entry. Should we therefore increase, and again type for me, should we increase or decrease the liability towards our shareholders? Increase it or decrease it? Are we going to pay them more than 50,000 or less? Increase or decrease the liability? Less. We're going to pay them less because a portion. Thank you, Sinevuyu, Millicent, Erasmus, Lorenzo. You're all correct. We are not going to pay them the full 50,000. We're going to pay them less. We're actually only going to pay them 80,000 of the 50,000 because 20,000 will have to be paid over to the revenue service. So if we are going to decrease our liability towards our shareholders, our preference shareholders, must we go and debit or credit that liability account, preference shareholders? Type for me, debit or credit? Remember, it's a liability, so it has a credit balance. If we want to reduce, decrease it. I'll do that just now, Priscilla. Let the students just type there. Must we now go and debit or credit that liability towards our preference shareholders? Debit. Thank you, Anil. Thank you, Erasmus. Debit. We must now go and debit that. Priscilla, why are we paying less than the 50,000 rands? If there had been no such a thing as dividend tax, then they would have received the full 50,000 rands. But in accordance with the Income Tax Act, it is the responsibility of the company that declares the dividend to withhold the tax portion. In other words, they keep the tax portion back before paid over to their preference shareholders or ordinary shareholders if this had been an ordinary dividend. And then we've got to pay that tax part, that tax portion, the 20% in this case. We have to pay that over not to the shareholders, but to the revenue service, right? So effectively, even though we have declared 50,000 rands as a dividend from our perspective, when we make the payments, we're going to pay 20% of that over to the revenue service, and the remainder, which is then 80%, we are going to pay over to the revenue service. Okay, so you were all correct there. It was less and debit and so forth. So now when we debit our liability towards our preference shareholders, we have to at the same time raise a liability towards the revenue service. So that means we've got to create a new credit balance. If you can type for me, which account are we now going to credit? Which account are we going to credit? Type there for me, please. I know it's a fairly long name for the account, so I'm going to give you a few seconds. What do we call that account? Current. I sound like a parrot. There we go. You don't need a question mark, Erasmus, because you're spot on. Millicent, you're correct, but you must now specify which kind of tax. Lorenzo, also 100% spot on. We're going to raise a liability towards the revenue service in the country or whichever country we've declared the dividend in. In our country, that will be the South African Revenue Service. So we're going to credit an account called current tax payable, and then we're going to distinguish that from, let's say, employees tax or income tax by calling it dividends tax. So current tax payable, that part indicates it's a liability, and then colon, and dividends tax indicates which type of tax we are talking about. Okay, so let's go and have a look at the solution. Let's I didn't mislead you. There we go. We've said the other day that dates are always important, ladies and gentlemen, whether you are doing journal entries, whether you are doing general ledger accounts, do not forget the date. So we know this took place on the 30th of December 2018. We said we are going to debit the preference shareholders. Why? Because we are reducing the liability towards them. And then we're going to raise a further liability, but that will be towards the revenue service in the country that we are declaring dividends. So we're going to raise that liability, and we're going to call that account current tax payable, colon, dividends tax. We've already said that the dividend tax rate is 20%, so it's going to be 20%, the dividends tax rate, multiplied by the dividend that you've declared, and that gives you the 10,000 rand. Right. Okay, any questions? Anyone who wants to ask a question in person by unmuting your mic? You can raise your hands if you wish to ask a question. Okay, it seems like it's all clear so far. So let's go to the second part of question 2. 2.2, let's see what is required of us. They say calculate the capital gains tax to be included in the company's taxable profit for the year ending 31st of December 2019. Okay, so here we can see clearly that we need to do a calculation. And what does the calculation deal with? The taxable capital gain. Now, before we can calculate the taxable capital gain, ladies and gentlemen, you'll remember hopefully from that lesson, even though it was only made available over the weekend, some of you might not have seen it yet. But the fact remains, when it comes to a taxable capital gain, you first got to calculate the capital gain, and then a portion of that capital gain will then be included in your taxable income. So now let's go and have a look at the question itself. They say, assume Garfield Limited had purchased a property on the 15th of September 1986 for 1 million rands. Now, those of you who've gone through the PowerPoint that deals with capital gains tax, you would have seen that capital gains tax, or CGT, came into effect in South Africa in 2001. Now, clearly, to be reasonable to the taxpayers, because the tax only came into effect in 2001, the Income Tax Act contains a formula to ensure that that part of the capital growth that took place prior to 2001, that portion that took place, the growth in the value of the asset that took place prior to capital gains tax coming into effect, that should not be taxed under CGT, but only that portion of the growth in the value of that asset since October 2001. And for that reason, they've created a formula to calculate what they refer to as a base cost. So anyway, they do not tell us what the original cost, was. Sorry, it was 1 million rands. But now from this question, they say the company sold the property for 9 million rands, and you have calculated the base cost to be 3 million rands. Now, what does that effectively mean? It effectively means that your value, the value in the of that asset, grew from the date of acquisition, the 13th of September 1986, to the effective date when value-added tax came into effect on the 1st of October 2001. It grew by 2 million rands, right? So it grew by 2 million rands. So that 2 million rands should not reasonably be taxed under capital gains tax. Only the increase in the value of that asset since since the advent or the implementation of capital gains tax in October 2001 until the date of disposal. So now we've gone and applied that formula and we have calculated that theoretically the value of that asset that we have now disposed of would have been 3 million rands on the 1st of October 2001. So only that growth from that date when value-added tax came into effect, which we have now calculated as the base cost to be 3 million rands, up till the date that we dispose it of, which was on the 15th of March 29, only that growth is regarded as a capital gain. So what will the capital gain be, ladies and gentlemen? It'll simply be the selling price. In other words, the amount that we have disposed of, the amount of the asset that we have sold it for, which is 9 million rands, less the base cost, which is 3 million rands. So that means the taxable gain in accordance with the Income Tax Act is 6 million rands. Those of you who have been able to, had the opportunity or the chance, the time to have a look at the PowerPoint on capital gains tax would see that in the case of a company or a corporate structure, a company or a CC in South Africa, the inclusion rate is then 80%. Whereas in the case of a private individual or a natural person, you and I, the inclusion rate is 40% currently. It used to be less previously. At one stage, it was 50% for companies and 25% for individuals. But now for the last few years, it's 40% for individuals and 80% for companies. So that means 80% of that capital gain, which we've just said is 6 million rands, will be included in our taxable profit before we calculate our income tax expense. So that means we're simply going to take the 6 million rands difference, the increase in the growth in the value of the assets since the 1st of October when CGT came into effect until the date that we've disposed it of, multiplied by 80%. So that means it's going to be, what is 6 times 8 is 48. So it'll be 4,800,000 rands. Right. So that is what is required of us to calculate the taxable capital gain. So that is after applying that inclusion rate, and then we must show our calculation. So let's go and have a look at our solution. There we go. So we've seen that the proceeds on disposal, that is, in other words, the amount that we've sold it for was 9 million rand. The base cost was 3 million rand, right? So that is the capital growth from the date of implementation of CGT until the date of disposal. That gives us a capital gain of 6 million rands. And in the case of a company, the inclusion rate is 80%. So we take 80% times that 6 million rands, and that provides us with a taxable capital gain of 4,800,000 rands. And then we add that to our taxable profit before we calculate our income tax expense. Okay, let's pause there for a little bit. Are there any questions, students? You're welcome to ask in person. You must just raise your hand before, or you can type your questions in the chat box again. No questions so far? Hopefully you can still hear me. Okay, so now let's go to question number 3. Don't want to show you the solution yet, just the question. There we are with question number 3. So like 2 weeks ago, I should say, a very good exam technique for every question in financial accounting or cost accounting or auditing, for that matter, is to go and have a look at what is required of you, because that then creates an expectation of what is coming up. So we see we've got all sorts of dates and information there. We've got additional information, and then we've got a required section. So what is required of us? Firstly, we've got to prepare the following general ledger accounts for the year ended the 31st of December 2018. Right, so we already get an expectation of what is coming. First of all, we have to prepare general ledger accounts, so we know what's coming. We also now can see clearly it is for the year ended the 31st of December 2018. So which two accounts do we need to go and prepare? First of all, ordinary shareholders, right? We've discussed that in question 2 already. So the ordinary shareholders, what will that represent? That will represent a liability towards our shareholders, right? So we'll have to go and look at what were the dividends declared for the ordinary to the ordinary shareholders, and then secondly, the current tax payable income tax account. Let me just see. Good morning, sir. I wanted to know which paper are we using today from Zintle. Zintle, we are using the 2019 Formal Test 2 paper. So the corresponding one to what you are going to be writing next week, Tuesday. You can find it under Content. And under Content, there's a subfolder called Assessments from last year, or perhaps it's called Assessments from prior year, something like that. There we go, the 2019 Formal Test 2 paper. Okay, now the ordinary shareholders, we're not going to look at that today because we've already done that 2 weeks ago. So you know when you declare a dividend, you have to debit the ordinary dividend. You're going to credit the ordinary shareholders. Then you're going to calculate the dividends tax portion, and with the dividends tax portion, you are then going to debit the ordinary shareholders account, and you are going to credit current tax payable dividends tax. So the one that we are going to be looking at now is our current tax payable or receivable, depending on whether it's got a credit or a debit balance for income tax, right? And then secondly, we've got to prepare the following note for inclusion in the financial statements for the year ended 31st of December in accordance with IFRS. Which note? The income tax expense note. Okay, so let's start with this one. Let's go and prepare this general ledger account, current tax payable if it has a credit balance, or current tax receivable if it's got a debit balance, right? So in your ledger, you can probably just call the account current tax payable / receivable. Like I said, all depends on whether it has a debit or a credit balance, whether that tax is receivable from the Revenue Service or payable to them. Bear in mind, ladies and gentlemen, that in 1 year, it is possible that it can have a debit balance, and in another year, it could have a credit balance. So if it has a credit balance, you'll find it under current liabilities. If it has a debit balance, you will find it under current assets. So let's go and have a look at the information provided. They say you are provided with the following income tax related information for OD Limited for the financial year ended 31st of December 2018. On the 1st of January 2018, now we've seen that is our financial year end, 31st of December 2018. So here, the date, 1st of January 2018, that means it is the first day of the current financial year, right at the beginning of the year. There they say the opening balance on the current tax payable income tax account, that is the one that we must go and draw up, reflects an amount owing to SARS of 25,000 rands. We'll read the rest just now. Just start for me quickly there. If it reflects an amount owing to the South African Revenue Service, does that represent a debit or a credit balance? Start for me, debit or credit? There we go, Benedict. There we go, Millicent. A credit balance. Remember, effectively, thanks, Lubabalu, effectively, they are a creditor of ours, right? So if we owe money to them, it means it's a credit balance. Thank you, Siva, as well. Okay, so we are going to start with a credit balance, and they tell us, where does that credit balance come from? They say the balance is the result of a provision for the last year, the 2017 income tax expense. So we provided for an expense of 350,000 rands. So that would have been a debit to the income tax expense account, and it would have been a credit to the current tax payable income tax account. And we've also made our obligatory provisional tax payments. We made a first provisional tax payment and a second provisional tax payment, and the two together in combination totaled 325,000 rand. So we credited our bank account with those two payments, and in total we would have debited our current tax payable income tax account. So it means we've credited it with 350,000, we've debited it with 325,000, so that provides us with that balance at the end of the year that we have carried forward, or carried down as they say nowadays, of 25,000 rands. Okay, I'm going to show you the solution later. I want us to talk through this, and you give me the answers first, and then we look at the solution. Then on the 1st of April 2018, so we are now in the 2018 financial year. On the 1st of April 2018, they say we received the tax assessment from the South African Revenue Service, which shows that the assessed income tax amount for the year ended 31st of December 2017 is 355,000. Right. So where are we? We are in the 2018 year. We're already on the 1st of April, April Fool's Day of 2018, but this still relates to the year of assessment ended 31st of December 2017. So they say our income tax has been assessed. It should have been 355,000 rands. How much did we provide for as an income tax expense? Type for me. How much did we provide for an income tax expense? What is the amount that we've provided? Let me just display that again that you can see. How much did we provide as an expense? There we go, Lubabalu, Priscilla, there we go. We have provided for an income tax expense of 350,000 rands. Now, clearly, we're not just going to accept the word from the Revenue Service. We're going to check our calculations and our estimates before we just accept that they are correct. But for our argument's sake, for financial accounting 2 purposes, we'll accept that they are correct and we are wrong. Right, it's not always the case in practice. There are all sorts of actions that you can dispute that assessment, but let's not go there today. Let's accept that they are correct. They say, even though we've provided 350,000 as an expense, our real expense for that 2017 year should have been 355,000. So now my question is very simple, ladies and gentlemen. Last year when we made that provision, did we provide too much or too little? Just type for me there. Did we provide too much for income tax or too little? There we go, Benedict. Very quick, very awake. You're on your second cup of coffee, I guess. There we go, Sinavuyos, Erasmus, Lubabalo. There we go, too little. So last year we provided too little tax. Thank you, Lukaba. So that means we've got to fix it, right? We've got to correct it in our financial statements. We've got to correct it in our books of accounts. So if we provided too little last year and we want to fix it, we want to correct that, do we have to provide for more income tax now or less? More or less? Do we now have to provide more or less to compensate for last year? There we go. Sinabuyo, Erasmus, Lubabolo, Annalisa, Rukawa. Oh, you're quick. You're quick. I am very impressed. Yes, we only provided 350,000 rands, but we should have provided 355. So that means we didn't provide enough. It means we have to go and provide for more. So what do we call a situation that we find ourselves in here? Did we last year have an over provision or under provision? Just type over or under. Was it an over or under provision last year? There we go. Oh, you are I think we should just give them 100% already, Mrs. Moore and Mr. Borman, and forget about the test. Okay, so that means to correct that, we will have to go and provide for more. So if we are going to have to provide for more income tax expense, which account we'll have to go and debit if we have to provide more? You've said we've underprovided last year. Now we've got to go and provide for more. Which account do we need to go and debit? Type, type, type. Don't be shy. How did we provide for it last year? Which account did we debit when we provided for our income tax expense? We debited which account when we provided for the expense? In. We debited income tax expense, right? And we credited current tax payable. That's what we said a little bit earlier as well. So now we've got to go and repeat that. We've got to provide for more. So we've got to do exactly the same. We have to go and debit again our income tax expense account, and we have to increase our liability. Remember, we provided too little, so our liability is not big enough either. So we have to go and increase that liability, the current tax payable income tax account. So therefore, if we want to increase the liability, we have to go and credit that account, right? So there we go. Now we have fixed that situation where we have underprovided last year. Then they say on the 5th of April, arranged for an electronic funds transfer to be made to SARS, the South African Revenue Service, for the amount still owing to the South African Revenue Service following the above assessment. Now, ladies and gentlemen, what we need to do there, we already have an opening balance, as we've seen there on the we have already now, and remember this is important, we can only do this once we've adjusted for the over or the under provision. Once we take into account our opening balance on the account, and once we've taken into account the adjustment that we had to do for either an over provision or an under provision, once we've done that, whatever the balance is on that account at that point in time is what is owed between the two parties. So if that balance then is a credit balance, that is exactly what we then owe to the Revenue Service. If that account then has a debit balance, that is exactly then what the Revenue Service owes us, right? So let's go and have a look. What is the balance on that account at this point in time? Let's go and see. I don't want to show the whole, well, I don't have a real choice in the matter here. I'll have to show it to you. Okay, so there we started with a credit balance of 25,000. That is what you said we have, a credit balance of 25,000. And now we've seen that we had to increase the liability because we had an under provision. We have to increase the provision for income tax. So we have to go and debit our income tax expense account, and we increase our liability towards the Revenue Service with the difference between what they said our real expense should be and the expense that we have estimated or provided for at the end of the previous year of assessment. And that difference is 5,000 Rand. So we're going to credit this account, the current tax payable or receivable income tax account, with that 5,000. And as we've said, we debit the income tax expense account with 5,000 Rand. So as it stands, forget everything else. Forget everything else, ladies and gentlemen. Just take those two, not that one, just those two entries into account. So at this stage, before anything else, what is the credit balance on that account? Calculate that for me quickly and then type it. Pleasure, Benedict. What is the balance on that account? If you do not take anything that must still happen into account, just take those two, the balance and the transaction into account. Type. 30,000. Thank you, Lubabalu. Thank you, Priscilla. Thank you, Lorenzo. Lukaba. Nkobile, thank you. So 30,000. So the balance on that account as it stands is 30,000. And as we've said, once we've taken into account our opening balance, and once we've taken into account the overall under provision that we've now corrected, whatever that balance is, or if it's on the debit side, whatever that balance is the amount owing between the two parties. And if it is a credit balance, like it is in this case, it means the revenue service is a creditor of ours. We owe them the money. Had that been a debit balance, it means that the revenue service at that stage would have been a debtor of ours. They owe us the money, and they would have to refund us that money. Right. Okay. Anyway, the fact is they said we paid the difference. The difference, let me just get back to the question there. They said we arranged for an electronic funds transfer, an EFT, so that means we have paid the amount that we owe to them. Now type for me quickly, ladies and gentlemen, if we make a payment, if we transfer money out of our bank account, which account are we going to credit? This is the easiest question of the day. If we pay money, which account do we credit? Bank. Thank you, Lubaba. Thank you. Bank. There we go. Very easy. So we're going to credit bank. And in this case, why did we make a payment? What? Thank you, Annalisa, Melissa. Thank you all, Monroe. Yes, we're going to credit the bank account. Why have we made a payment? Because we owe money to the revenue service. Once we have made the payment, we no longer owe them that money, right? So clearly then, which account are we going to debit? I know it's a long account name. You can use abbreviations here in the chat box, not on your answer sheet, just in the chat box. So which account is the appropriate one to go and debit now? Say something. Yes. On which account does the liability reside? The liability resides in our... Now let me go and have a look there quickly. There we go. The current tax payable income tax account. Lubabala, always remember, I know that I said you can use an abbreviation, so don't worry. But always, like Anil did there, also indicate which type of tax, please. Because we might have a current tax payable for income tax, as well as dividends tax, as well as for employees tax, and so forth. Okay, but anyway, you are both correct. Right, so the liability sits in that current tax payable account. We no longer owe it once we've made the payment. So there we go. We've credited our bank account because we make a payment. And the amount that we are going to that we are going to do an electronic funds transfer or EFT for is what we believed we owe them at the beginning of the year, plus that extra amount. So that will be 5,000 plus 25,000 gives us 30,000 rands. I'm going to ask you something here. I think Mr. Borman especially will appreciate this little question because Mr. Borman also presents Financial Accounting 3. In Financial Accounting 3, you're going to not only do current tax, you're also going to be doing deferred tax. So you're going to revise a little bit initially on current tax before you start doing the deferred tax. So let's maybe just ask you two little questions. What was the amount that we underprovided? Type that for me quickly. We mentioned that about 10 times already. What was the amount that we've underprovided for the year? Type for me there. What was our under provision? 5,000. There we go. 5,000, 5,000, 5,000. Excellent. You are all correct. However, let's maybe ask the question a little bit differently. What was the amount that we underpaid last year? Not underprovided. What was the amount that we underpaid last year? Trick question, I know. Underpaid. There, Lorenzo's got it right. I'm just talking about underpaid. Lorenzo's got it correct there. The amount that we have, There, Zintley, you also got it right. The amount that we have underpaid is 30,000 rands. That is what we paid too little. There are actually two ways in which you can find an answer to that question. Let's discuss both ways. What did we still owe them according to our own books of account? What did we owe them at the beginning of the year according to our own books of account? 25,000 rands. But that balance included an under provision of 5,000. So we truly own them 30,000 rands for the 2017 tax. That is why we've got that payment of 30,000. So that was our underpayment. There's a different way, actually, if you want to go there, how we could have calculated that as well. So let's see how much did we pay last year. How much did we pay last year? In total, our provisional tax payments for last year, how much did we pay? 325,000. So we've made a first provisional tax payment of X rand. We made a second provisional tax payment of X rand. In total, we paid 325,000 rands. But SAS tells us, how much should we have paid for last year? Yes, let me see if you've typed something. You've all got it right. Benedicte? Yes. So we've paid a total of 325,000. If you can type there again, how much do they tell us we should have paid in total? 355. Benedicte's got it spot on again. Rukwaba as well. So they tell us in total we should have paid 355,000. So that means how much did we underpay by? What was our underpayment? Type it again. Keep your fingers warm. Type again. There we go. Lubabalo, Sinobuyu. Yes, so that gives us exactly the same answer. Yes, Rukwaba. So we get to the same answer. So our underpayment, thanks Anil, our underpayment was 30,000, which we've already determined. Okay, so you get the idea. So let's go to our next event. So that took place on the 5th of April. We did the EFT. So our next event is on the 29th of June. Now you already know by now, on or before the last day of the first half of your financial year. In this case, it would have been the 30th of June, but you can pay it before. You just cannot pay it later than the last day of the first half. You have to make a provisional tax payment. So here they've made a provisional tax payment to the South African Revenue Service for the year ending. You see, ending, not ended, ending. For the year ending. We are not there yet. We are now only at the 29th of June. So we're just about halfway through the year. The year hasn't ended yet. Okay, so if the year hasn't ended yet, can we then write that off or create an expense? Can we record that as an expense yet? Is there an expense for tax if the year isn't even over yet? Yes or no? Type for me. Yes or no? Can we create an expense for the year if the year isn't over yet? No! Thank you for those answers and apologies for shouting. No, the year isn't over yet, so you cannot create the expense, the income tax expense for the year yet because the year isn't over yet. So what happens if you are making a provisional tax payment? You are paying the expense which will eventually come at the end of the year. You are paying that in advance, right? So it is like a prepayment. So it is an expense paid in advance. So you are creating a debtor. If you have a terrible second year and it turns out you've got no taxable profit, it means that payment that you've made, the Revenue Service will have to refund it. So the answer there, thank you for answering, Priscilla and Kobile, but the answer there is actually no, it's not an expense yet, it's an expense paid in advance. So you have to create an asset for that, like a prepaid expense account. But we are not going to call it prepaid expense or anything else because we've got a ready-made account already for what SARS is either owing us or we are owing them. What is that account called? It is our, that one, current tax payable, or current tax payable colon income tax account, or current tax receivable if it's a debit balance. Okay, so we're going to debit that account. We've made a payment, ladies and gentlemen. What is going to be your contra account? I need you to type this for me. If you make that payment, are you going to then credit an account called first provisional payment or something like that? Or what is your contra account? There you go, Benedicte. There you go, Millicent. Thank you, Anil. Bank. Remember, you are making a payment, right? You are talking about another general ledger account. Thank you, Sinuvuyo. So you are going to be crediting your bank account, right? Where were we? First, so then our second provisional tax payment, clearly there they show us the amount was 180,000 rands. Then we also know on or before the last day of the year, the full financial year, we've got to make a second provisional tax payment. Our financial year ends on the 31st of December. They are doing it the day before. Remember, sometimes it's better to be early than to be late with your payment, because you can be 5 days early, you can be 1 day early, you can be a month early, and you're going to pay that big. But if you are 1 day late, if you only paid on the 1st of January, which is in any case a public holiday, so they only get it on the 2nd of January, they're going to slap a penalty. They're going to slap you 10% of that 190,000. So you're going to pay a penalty of 19,000. You want to avoid that, right? So you make sure that you pay it a day before the last day of the financial year. Okay, we've basically discussed the entry, but let's just redo it again. You make your second provisional tax payment. Again, your year isn't quite over yet. You must still go and do your final year-end entries after the end of the year in January. So you are still paying that expense in advance. So the account that you are going to be debiting is still current tax payable, income tax, right? So it is still a prepayment because we haven't finalized our accounts and our financial statements for the year yet. Which account are we going to credit? You've all typed that a few seconds ago. We are making a payment, so that means we are going to credit our bank account, right? Okay, ladies and gentlemen, let's just go and have a peek at our ledger account there to see whether I haven't misled you. I don't actually want to show you the right-hand side. Doesn't help me holding my hand over that pot. You can still see it. So just look at the debit sides. There we go. We credited bank for the first provisional tax payment of 180,000 same year. We credited bank, and in both cases we debited the current tax payable or receivable income tax account. First provisional tax payment 180,000 rands. Second provisional tax payment 190,000 rands. Okay. Now the last date that we've got here is I will once we're done with this, we will get all your questions if there are those that Mrs. Moore or Mr. Borman hasn't already answered. So here they say on the 31st of December, this probably actually takes place in January, but you haven't closed off your books. You can still backdate it to the 31st of December. So you're going to record it as at the 31st of December. They say you provided for the income tax expense for the year ending the 31st of December 2018, right? So you provided for the income tax expense for the year ending 31st of December 2018. So maybe let's get the structure of our journal entry correct, and then we can worry about the amount. We can see there's all sorts of additional information, so the amount is going to take us a while to calculate. But if we are going to provide for the income tax expense for that year, type for me there quickly, which account are we going to debit? Remember, now the year over and done with. Now we actually are going to create and record an expense. Which account are we going to debit? There we go, Millicent. You are quick this morning. Thank you. So we are going to debit the income tax expense account. At the same time, now that we are creating the expense, now that the year is over and dusted, now we have to raise the liability towards the revenue service. So which account are we going to credit? If you can type that for me as well, please. Mrs. Moore actually used the name there. There we go, Benedicte. Current tax payable, that now represents the liability. Which kind of tax are we referring to? Not dividends tax, not employees tax, not stamp duties, income tax. Thank you, Benedicte. So you're going to call that account current tax payable, yes. Thank you, Priscilla. Thank you, Rukwaba. Yes, so it deals with income tax. So the full name of that account will be current tax payable, income tax. Right, so we've got the structure of our journal entry. So that means we can go and just book it over to our ledger account. So we know that we are going to be debiting the income tax expense account, and we know we are going to be crediting the current tax payable income tax account. Right, so that will be part of the ledger account that we are disclosing for the purposes of this question. So now it is a matter of going to calculate what is the amount, the value of the income tax expense that we must go and provide. So for that purpose, I just heard that there were some answers coming in. Oh, thank you. It was Mr. Borman posting it there. Quite correct. Thank you, Mr. Borman. So now we have to look at the additional information. First of all, they tell us that the income tax is levied at 28%. We know that about 20 years ago, that corporate tax rate was 30%. Then at one stage, it was decreased to 29%. Now for the last 6 or 7 years, or possibly not that long, for the last 5 years at least, it has been 28%. So we have that rate that we must take into account. By the way, ladies and gentlemen, if you think forward to the note, type for me, what do we call that tax rate? What do we call it in our note? Priscilla, we are crediting the account that Mr. Borman mentioned just in the previous chat there. The full name of that account, we are crediting current tax payable, income tax. What do we call that rate, the 28% that is prescribed by the Income Tax Act? That is now 28%. That was 5 or 6, 7 years ago, 29% and so forth. In our note, what do we refer to that as? The applicable. There we go. You are very sharp. I can unfortunately only see your student number. Lorenzo also correct. That refers to the applicable tax rate, applicable to that specific financial year. Okay, if you had been doing, let's say, the income tax for 2010, for argument's sake, that would have, the applicable tax rate for that year would have been 29%. Dividends tax is levied at 20%. Like we say, we've already done that calculation. We've done that entry, the correcting entry. Then they tell us here, included in the profit before tax for the current year of 1,314,000. So that means our profit before tax. You can maybe make a little note if you've got a pen and paper ready there, or a pencil and paper right there. Our profit before tax for the current year is 1,314,000 rands. So they say included there. Included there is a fine of 15,000 rands. Included is a fine of 15,000 rands. So we paid a fine, a traffic fine, or some sort of a penalty that was imposed on us. Now, I want you to just type yes or no. Can we use a fine as a tax deduction? Yes or no? Can we use a fine, something that is supposed to punish it? Can we use it to our advantage? There we go. Lots of people, you are all correct. No, we cannot use it as a tax deduction. So therefore, when we do our tax calculation, we have to adjust it. So what we have to ask ourselves, is it really an expense? Just listen to me. I'm not talking about a tax implication. We paid the fine. It was imposed on us. Is it really an expense for us? Yes or no? I'm not talking about tax. Is it an expense? It is actually an expense. Yes, Lukova, you've got that right. It is an expense. Unfortunately for us, we were slapped a fine. So that means, ladies and gentlemen, because it is an expense, it means we have deducted that expense of 15,000 in arriving at the profit before tax, right? It is already deducted. But now, as you have all correctly said, it is not deductible for income tax purposes. It is a non-deductible expense. So in order to go from this figure where we've already deducted it as an expense and to arrive at our taxable profit, what do we have to do with that 15,000? We have to add it back or deduct it. If you can just type for me, add back or deduct. There we go, Benedicte. There we go, Sinevuyu, Sive, Lubabalu. No, Sive, Lubabalu, no. It has already been deducted. Remember, it's an expense. So you've already deducted it in arriving at profit before tax. Grady's also got it right here. Now, to arrive at your taxable profit, you have to add that back. It has already been deducted in arriving at that figure because it is an expense. But you cannot deduct that expense for tax purposes. So if you use that as your starting point, it means you have to add that back. Is that clear, ladies and gentlemen, why we're adding it back? Just yes or no? Especially Sive and Lubabalo, you understand now why we're adding it back? Thank you, Sinevu. Thank you, Lubabalo. There we go. Okay, so we're adding it back. Then they say also, included in the profit before tax of 1,340,000 is dividend income of 9,000 rands. Right. Now, we already know at this stage that dividends declared or any kind of dividend is subject to dividends tax, right? Now, there are all sorts of provisions in the Income Tax Act to prevent double taxation. There are even tax agreements between various countries, between South Africa and Britain, or South Africa and Botswana, and Britain and Germany, and so forth, to prevent double taxation. So there are very many measures in the Income Tax Act to prevent double taxation. So this dividend income of 9,000 rands, has it already been subjected to some kind of tax before we even receive it? Yes or no? Yes, Sunavuyo, you're correct. Yes, Lubabalu. So, ladies and gentlemen, yes, before we even receive that dividend, the company that declared the dividend, where we receive it from, they would have withheld the tax portion, that 20%. They would have withheld it and paid that over on our behalf to the revenue service. So we are just getting the 80%, if you know what I'm referring to. So we're just getting the net amount. So that 9,000 has already been subject to a kind of tax, which is dividends tax. So would that be fair if it is taxed again under income tax? Yes or no? No, thank you, Nkobile. No, thank you, Benedicta. No, that would be unfair. Now you are taxing the same thing for a second time. Thank you to all those who have said no. So, therefore, to prevent double taxation, that is what we refer to now as exempt income, an amount that is not taxable. However, ladies and gentlemen, is that amount included in our profit before tax? Yes or no? Is that dividend income already included there? Just type yes or no. Is it already included? Yes, Lubabalu. Yes, Grady. Yes, Anil. Yes, Chiska. Thank you. Welcome. Yes, it's already included in there. In fact, ladies and gentlemen, if you think back to revenue, what does revenue consist of? Revenue from sale of goods, revenue from services rendered, revenue from dividend income. There we go. Revenue from interest income, revenue from royalties income. So that dividend income was part of your revenue already. So it is included there. It's already been added as income. It is income, part of revenue. It has already been included there. So now for tax purposes, are we going to add it in again a second time, or are we allowed to deduct it now? Add or deduct? Thank you, Benedicte. Thank you, Monroe. Thank you again, Lubabala Sunavuyu, Lukoba, deduct. It's already in there, right? As you know, it's part of revenue. It's already been taken into account in arriving at profit before tax. So now for your benefit, because it's not taxable, you can deduct it in order to arrive at your taxable profit, right? Okay, ladies and gentlemen, then we also see paragraph 4, an ordinary dividend was declared. We can talk about that just now. So that will clearly deal with dividends tax. So we'll talk about dividends tax just now. So let's just finish with our income tax part. So what is our taxable profit? Please, ladies and gentlemen, calculate it for me and type it for me. You now know we start with our profit before tax. We add back the fine, then we deduct the exempt income, which is already included in there. What is going to be our taxable profit? There we go, Lubabalo and Kubile, 1,320,000. Jiska, thank you very much. So that is our taxable profit. So we have now done what? We've converted our, what we refer to as our accounting profit, the profit that we've calculated in accordance with the IFRS, which we disclose as the profit before tax. Remember, the profit before tax equals your accounting profit, and we've converted that into a taxable profit, right? That is calculated in accordance with the Income Tax Act. So once we have calculated the taxable profit, what do we need to do to go and estimate our income tax expense? We've got to take the taxable profit that you've just typed there, multiply it by the applicable tax rate, right? Multiplied by the applicable tax rate. If you can just type a few answers for me there, if you take that taxable profit multiplied by the applicable tax rate of 28%, what do you get? Go and have a look there quickly. Yes, Benedicte. Yes, Lubabala. You've all got it correct. There we can. Thank you. There we can go and disclose it. So we take the 1,320,000, apply the applicable tax rate of 28,000, gives us an income tax expense that we estimate for the year of 369,600 rands. Right, and we've already looked at the structure of the journal entry, so now we simply post it. It means we are going to debit our income tax expense account with that amount, and we are going to credit the current tax payable or receivable. In this case, payable or receivable. We'll see what the balance is, income tax, right? And that is all the transactions for that year. Now we only are going to look at in the following year when we receive the tax assessment for this 2018 year. That is when we are going to continue working on this account. But now we can close it off, not close it off, excuse me, balance it off for the year. So if we balance it off, we see that the largest side is the debit side. We add that up, gives us 400,000 rand, I should say. We copy that total over to the opposite side, 400,000 rands. We add up the top three transactions there, and we see our balancing figure is 400 rands. We carry that balance forward or down to the next year, which is now 2019, 1st of January. We carry it down 400 rands. Excuse me. Okay, so that covers that particular financial year. Let us just pause for maybe 30 seconds and see if there are anyone who wants to ask a question in person. I agree with Mrs. Moore there. No questions in person. Okay, then we still need to do the income tax expense note. The second requirement there, prepare the following note for inclusion in the financial statements for the year ended 31st of December 2018 in accordance with the IFRS. The note that we've got to go and disclose is our income tax expense. Okay, ladies and gentlemen, now we know from the lesson that you've gone through, the class that Mr. Borman also had last week that we've posted to all the sites, that note consists of two parts. The first part deals with what is included in income tax expense. What are the amounts that we include in our income tax expense? And the second part of that note is what we refer to as the rate reconciliation part. So now we can use all the figures that we've calculated so far, and we are going to calculate, we are going to describe the note. Let's just look at the first part of the note. We've got to see what is included in our income tax note, our income tax expense note. Before we do that, ladies and gentlemen, let's maybe go and have a look at what does the income tax expense account for the year look like. Unfortunately, I do not have the income tax expense account in my solution, but let's go and do it for ourselves by looking at the current tax payable account. If I can just find it, there we go. During the course of this year, how many times did we debit the income tax expense account? You can just type a little number for me. Look at that current tax payable account, and in doing that current tax payable income tax account, how many times did we debit income tax expense? I'm giving you a little hint. How many times did we debit it? Yes, Sive? Anil, no? Yes, Sivuyu, Millicent, yes, if you have a look at that, I'm displaying it again. That's not working. There, twice. We debited it there with 5,000 rands. There was the first time. It was the first time we debited with 5,000 rands. What did that represent? That expense, that represents the under provision for the previous year. Remember, that is where we corrected after we received the assessment, where we fixed it, where we fixed our under provision from the previous year. That was on the 1st of April. There was the second time. There was the second time we again debited income tax expense with 369,000. Right. So we debited it twice. We debited with a total for the or during that year of how much? Type for me the total. How much did we debit it in total? Thank you all. That's written there 2 times. Yes. So what is the amount in total that we debited that account with? No, we debited there was 5,000 rands once, and we've debited it there with 369,600. So how much did we debit that income tax expense with in total? There we go. Landela, Lukoba, thank you, Sinevuyu. We debited in total with 374,600 rands. Right. So that means at the end of this year, that is the balance on the account. And as you know, that is an expense account. So it means at the end of the year, we're going to close that account off. Now type for me there, to which account are we going to close it off? All expenses, all income, except sales and purchases. So to which account are we going to close that expense off? What do we call that account? Our profit or loss account. Does that ring a ding dong? Yes, there we go. Thank you, Sinevuyu. We're going to close it off to our profit and loss account. So if we close it off to our profit and loss account, the amount that we take to our profit and loss account would therefore be 374,600 rands. Right. So what is the amount that is going to appear on the face of our statement of comprehensive income as an income tax expense? Type it for me there quickly. What is the amount if you take that amount to your profit and loss account? What is the amount that is going to appear as an income tax expense on the face of your statement of comprehensive income? Type. It is going to be exactly that. It is, there we go. Thank you, Anil. It is going to be, there you go. Thank you, Sinevuyu, Rukwaba, Landela. It is going to be 374,600. But does that relate only to this year's expense? Yes or no? Does it only relate to this year's expense? Yes or no? Type. We've got a little bit of a difference of opinion. Mrs. Boer has helped you a little bit there. Yes, even though we are only writing it off to this year's profit and loss account, we must now bear in mind that it actually consists of two parts. It consists of that 5,000 rands, which is a correction of something that happened last year. There we corrected an under provision from last year. So even though it is part in our expense for this year, it doesn't relate to this year's expenses. It relates to last year's expenses. The only part that relates to this year's income tax expense is the 369,600. So that is exactly what we have to go and explain to the users of the financial statements. This is what that first part of the note is for, is so that we can go and explain to the users of the financial statements why do we have an expense on the face of our statement of comprehensive income of 374,600, but the income tax expense for this year was only 369,600. That is what the reason is why we have that note. So there we're going to explain to them. It relates to the current tax. The reason we call it current tax, in next year, Financial Accounting 3, you're going to deal with something we call deferred tax. So the current tax is just to distinguish it from deferred tax. And this current tax is for the current year. In other words, for the 2018 financial year or the 2018 year of assessment. Right, so it's the current tax, not provisional tax, for the current year. And that is the amount that we provided for at the end of the year when we applied the applicable tax rate to our taxable profit, which gave us the 369,600. But that is not the amount that appears in our statement of comprehensive income. That is the one because that is the amount that we took to our profit and loss account. So clearly that will appear on the face of our statement of comprehensive income, and there we describe it. There we describe it exactly like we've said. Total income tax expense as per statement of comprehensive income. So that is more than the income tax expense or the current tax for the current year. What does that difference represent? It is our current tax. It still doesn't refer to deferred tax. It's still the current tax, but that refers to an under provision in the prior year. So an under provision from last year. In other words, we in this year's accounts had to provide for an extra 5,000 rands expense, but it didn't relate to this year's, didn't relate to the current year expense. It related to a prior year expense, right? So in order to then disclose to the users of the financial statement what is included in our income tax expense note, it is the expense for this year, but also the expense that we underprovided for last year. Let me just have a look at the chat box. If there was an over provision, would we decrease? Yes, absolutely. You're quite correct. Didn't catch your name. Benedicte. Quite correct. If it had been an over provision in the previous year, then it means last year you provided too much. Then in this year's accounts, you will decrease that provision. So you'll do the opposite of what we've done. In that case, you would credit your income tax expense because you want to make the expense less, and then you would debit your current tax payable income tax account. So that means if you had an over provision, this would decrease the amount that you're going to show in the statement of comprehensive income. So that will then be a negative. Does that answer your question, Benedict? Thank you, Benedict. You're welcome. Okay, so that your entry, your journal entry would also then have been exactly the opposite, right? I think there is one of those questions that you were supposed to do, questions 2, 3, 4, and 5. Either one or two of them, you have a situation where there was an over provision. Okay, then the second part. The second part of this note is what we refer to as the rate reconciliation, or you can also call it your tax rate reconciliation or income tax rate reconciliation. But, ladies and gentlemen, do not only call it reconciliation. That says nothing. So either call it the rate reconciliation. The users will know you're talking about the income tax rate because this is the income tax expense note. So at least call it rate reconciliation, or you can call it tax rate reconciliation. So what do we do here? We are going to repeat our income tax calculation. There are two exceptions to that general rule. So we are going to repeat the income tax calculation, but we are going to show only the tax effects. So we're not going to show the gross amounts that we used in our income tax calculation. We're going to show the tax effects, which means literally that we're going to apply the applicable tax rate to whatever amount we used in our income tax expense calculation. The second thing that we must bear in mind, besides our tax calculation, there is still this little matter. This little matter of an under provision last year that we had to correct in this year's books of accounts. So that part, the first one, the second one, the first one, first line, the third line, the fourth line, that all come from your tax calculation. But that little line there, we must remember, does not have to do with this year's tax calculation. It has to do with an under provision relating to last year's tax calculation. Okay, so how do we start this part of the note, the second part, which we call the tax rate reconciliation or rate reconciliation? We start by disclosing the applicable tax rate. So we write there, or we type there, applicable tax rate. That is the rate prescribed by the Income Tax Act. Now remember, ladies and gentlemen, you'll have at least two columns here. You'll have this year's column, and then if this is published financial statements, you'll have the previous year's column, what we refer to as your comparative figures. So in each column, you will indicate what was the prescribed or applicable tax rate for that year. So do not write the tax rate there. Don't write it right next to applicable tax rate. Write it or type it under the appropriate column. So this will be 28%, the applicable tax rate. It could be that in the previous year, it was still 29%. So if you are drawing up, let's say, the financial statements for 2015, it could be that this year it was 28%, but in 2014 it was actually 29%. So whatever the applicable tax rate for that particular year was, you write in your that appropriate column. Then we give it a little subheading, the tax effects of, and then we are going to repeat our tax calculation. So with which amount, or let's say description, where did we start our tax calculation? We started our tax calculation with the accounting profit. And that accounting profit is disclosed as what in your statement of comprehensive income? It is disclosed as profit before tax. That is exactly how you're going to describe it in this second part of the note. So you're going to type there or write there profit before tax. And you remember the amount that we used, that we started our tax calculation with. If I can just find it. There we go. They said included in the profit before tax for the current year. So the profit before tax for the current year was 1,314,000. So in our tax calculation, we started with that. Then we added that fine back. And then we deducted the dividend income. Remember, that was our tax calculation. Right. That was our tax calculation. So now we basically repeat it in our second part of the note, but we're not showing the gross amounts, not the gross amounts, not the gross amounts, but the tax effect of those gross amounts. In other words, we have to apply the applicable tax to each of them. That is exactly what we are doing in this second part of the note. So we are repeating our income tax expense calculation, except that we are showing the tax effects thereof. And then the other that we've got to bear in mind that wasn't part of our income tax calculation for this year. It deals with last year. Okay, so that was the first part of the income tax expense calculation. We took 1,340,000, but now we're going to disclose the tax effect. What is the effect that profit before tax had on our tax? Right? This is what we are saying. What effect did the profit have on our tax? And our tax is at a rate of 28%. So the effect on our tax was that it created a tax expense. The profit before tax created a tax expense of 367,920 rands. Let's skip that second line. Then what did we do? We added back the non-deductible expenses. In this case, it was a fine. We added back the fine of 15,000 rands, but here we are only showing the tax effect. So the fact that we are adding back 15,000 rands, what effect did that have on our tax? It had the effect of increasing our tax by 4,200 rands. Right. We can look for questions just now. Then in our tax calculation, we deducted. What did we deduct? Exempt income. What did the exempt income represent? It was our dividend income. How much did we deduct? We deducted 9,000 rands. But again, we are not showing here, we are not disclosing the gross amount, we are disclosing the tax effect. So what effect did this 9,000 rands worth of exempt income have on our tax? It reduced the tax by 9,520 rands. 9,000 multiplied by the applicable tax rate. Right. So that there we've in effect repeated our tax calculation, except that we show the tax effects and not the gross amounts. Right. But then we mustn't forget about that one other little item that doesn't relate to this year's tax expense. We had to record it in this year's books because we've already closed off last year's books. So we had to record it in this year's books, but it related to last year's expense. It was an under provision in the previous year, which means we had to provide for more income tax this year, even though it relates to last year. So that has an effect of increasing our income tax with another 5,000 rands. The question might come up now, if it had been an over provision last year, if you had provided less tax for last year during this year, that would have been a minus, that would have been in brackets, which means this over provision, that would then be an over provision prior year, would also be in brackets. So that will then reduce this year's income tax expense. And then, ladies and gentlemen, we've got to go and add that up. We know that that is the figure disclosed in our statement of comprehensive income. This has to balance with it. That has to add up to exactly the same figure. And your description is also going to be exactly the same. That represents total income tax expense as per our statement of comprehensive income. And then just the last part of this second section of our income tax expense note. Just before we do that, let's just see, are there any further questions? If you want to ask something, you can raise your hand. Lukwaba, if the under provision is for this year, do we still add the amount? Lukwaba, by definition, you are going to provide this year for as much as you believe your income tax expense is going to be, right? And you'll only get the assessment from SARS in the year after that. So because of that, an under or over provision cannot be for this year. It can only be for a previous year. You are doing the correction of the under provision from last year, or you are doing the correction of the over provision of last year in this year's accounts, but it does not relate to this year's income tax expense. I hope that does that answer your question. Otherwise, you must ask it again. So you cannot have an under provision for this year. You can have an under provision for this year, but you'll only account for it next year, if you understand what I'm saying. So if we get to the 2019 financial year, and in May 2019, the following year, you get your tax assessment, only then you will find out whether you over or under provided this year. You do not know it yet. You can only find that out once you get your assessment. And that will not take place this year. That will only take place somewhere in 2019. Only then, next year, will you know if there was an under or an over provision for the 2018 year. There you go. Thank you very much, Mrs. Moore. I think, thank you, students. I see you understand that now. Let me just go back there. I see there was another. Thank you, Mr. Borman, as well. So there we have the answer. So you only know next year. Then the last section here, ladies and gentlemen, is just to indicate to the users of the financial statements. Now you must remember, what will the users of the financial statements see on the face? Now listen carefully. What will they see on the face of their statement of comprehensive income? They will see profit before tax of 1,314,000. That is what they will see. What will they see just below that? Just under the profit before tax will be a line item that states income tax expense. What will they see there? They will see an amount of 374,600 rands. Right, that is what they will see on the face of that statement. So if we do not provide them with a reason Why? That is not exactly 28%. They don't know. More than 28%, they will say, well, this accountant is stupid. They're paying a higher rate of tax than they're supposed to. Or if they calculate it and they say it's less than 28%, they will say that accountant is a scallum. That accountant cheats. He's not paying, or she's not paying 28%, because clearly what I see in front of me on the face of the statement of comprehensive income is profit before tax, 1,314,000 rands, and in the very next line I see an income tax expense of 374,000. Why? Right, now we can go and explain them, explain to the reader. This is what we've done there. We've explained to them it is because there were certain items included in the profit before tax that were either not deductible for income tax purposes, or they were not taxable for income tax purposes. So now we can show what is the effective tax rate. So effectively, we are now going to show, yes, on the face of our statement of comprehensive income, we've got an income tax expense of 374. So we show that as the part above the line in our calculation. What do we see on the face of our statement of comprehensive income? Profit before tax of 1,314,000. So we use that below the line in our effective tax rate calculation. So we take the actual income tax expense less the profit before tax. In other words, the two amounts that are just one next to the, or not next to the other, one just below the other on the face of our statement of comprehensive income. We convert it to a percentage and we see that the effective, even though the applicable tax rate is 28%, effectively this company paid tax on this year's profit before tax a little bit more than 28%. In fact, 28.5, 28.51%. Why is it apparently more? What is the main reason for that? Well, we can see what increased it beyond the 28%. First of all, we can describe it. We can always start this explanation with effective tax rate. The effective tax rate, well, is it more or less than the applicable tax rate? 28.5 is more than 28, right? So it is more than the applicable tax rate. Why? Because we had to provide for more tax this year relating to last year. So due to an under provision of the prior year, and also what else played a role, there were certain expenses that we could not deduct for tax purposes. So we include that there, and the non-deductible expenses. So both of them, anything here that caused a positive, a plus in other words, not a negative, that would have increased the effective tax rate. So we can go and describe it there. This description here is not a requirement of the international accounting standard, but many accountants do that just to give a more thorough or more complete explanation. Most accountants will see for themselves. Why is that more? Well, because of those two pluses. Right, ladies and gentlemen, that is all from my side, except for answering your questions. So I'm going to minimize this, and then we're going to give you an opportunity. First of all, maybe Mrs. Moore, she will be typing. Her microphone doesn't work. We'll just check with whether Mr. Borman wants to add something here, and then we'll give you a few minutes to ask questions, either in the chat box again or in person.
No questions from my side, Mr. Van Rensburg. Maybe you can just look at the chat box.
Thank you, Mrs. Moore. Thank you for that. The one question I see there, let me just stop sharing that screen. How is the formal test going to work? Okay, we are going to send you an email about this on Friday. It'll probably be just middle of Friday afternoon. We're going to send you an email describing it exactly. But Mr. Borman, Mrs. Moore, if it's okay with you, we can discuss it now as well.
That's right. You can discuss it now if you feel like it, Mr. Van Rensburg.
Okay, right. So let us discuss it now. Then the students know already. Thank you, Mrs. Moore, as well. Yes, it covers share capital as well as taxation. So that is what it covers. So Mrs. Moore preempted the next question, which is what is the scope? The scope is anything that you've learned this term. So that includes taxation matters as well as share capital matters. Now, if it had been a written test, it would be a 2-hour paper. It is still a 2-hour paper. You're still going to write it. You know, very often one thinks because we're doing it slightly differently, we're doing it electronically, that everything changes. Almost nothing changes. So everything will be almost the same as before. We are just going to do it slightly differently. So it's still a 2-hour paper. You would have received the assessment timetable Friday afternoon. It was released Friday afternoon, and then I forwarded to all the students. So you know we're writing at 9 o'clock on Tuesday the 14th. So ladies and gentlemen, you're writing from 9 o'clock. So 9 o'clock you will be presented with your question paper as well as an answer sheet. If I forget, remind me please that I say something else about the answer sheets a little bit later. So at 9 o'clock, you are going to be presented with that. So you can go, in fact, from 7 o'clock, you will be able to see the folder. So if you go to the online test main folder on Blackboard, from 7 o'clock that morning, you will see there is a folder. It's already there, but you will only be able to see it from 7 o'clock on Tuesday morning, the 14th. So there's a folder called Formal Test 2. 7 o'clock, the answer sheet will already display there, right? So even though the test starts at 9 o'clock, you won't see the question paper at 7 o'clock, but you'll see the folder from 7 o'clock, and from 7 o'clock, the answer sheets will be there. So if you are in the situation that you can print it, we are going to include the answer sheet. We're going to include it as an attachment to the email with the instructions on Friday. So if you have printing facilities, you can print it on Saturday, or if you are going to work on Monday, you can print it at work on Monday. So those who can print it, and then it's very handy, it's very convenient, then you can use it to do your question paper, right? Or if you do not have printing facilities, then you can use that answer sheet to simply copy it. You can write on your own pieces of paper, in your own study book, in your book, write the template there like it is in the answer sheet. Sir Liefle, regarding the answer sheet, is it okay to type in our answers and then send it as a PDF? No, Liefle, you're not going to send it whatsoever. You are actually then going to do a further test, right? Let's call it phase 1 or stage 1 and stage 2. So you're not going to upload it, you're not going to send it to us. You just go write the test, right? Or type it. You can type it, but only for your own purposes. So you're welcome to type it, you're welcome to write it. But it's still for your own purposes. So then 9 o'clock, you get the paper in front of you and you write the test, right? You write it on that answer sheet or answer book that you've printed, or you write it on your own pieces of paper that you've created from the answer sheet. And then, ladies and gentlemen, you get 2 hours to do that, right? So that takes us to 11 o'clock. So that's from 9 o'clock to 11 o'clock, 2-hour paper. That is when you have to do it. Then at 11 o'clock, an online test will open, right? So it's already there, but you cannot see it before 11 o'clock. 11 o'clock, the online test will open, and then you've got to use your answer sheets, either typed or written, either the printed one or the one that you've handwritten, doesn't matter. You have already drawn up your financial statements in hand or in typing. You've already done your journals. You've already done your ledger accounts. Now it's a question of using what you have written as the basis for the online test. Now you're going to get an online test, and the online test is going to ask you various questions that you now have already answered. For instance, let's say they've declared an ordinary dividend of 10,000 rands for argument's sake, right? Then a question will be, if they declared an ordinary dividend for 10,000 rands, which account are you going to debit? And then you'll get a few options, right? We already know, even without seeing the options, we are going to debit ordinary dividends, right? So one of the options will be ordinary dividends, another one might be preference dividends, another one might be current tax payable, the other one might be purchases or something silly like that. Then you simply select the correct one. There will be certain answers where you have to provide more than one option. So for instance, they might require for you to tell in the online list, online test, the complete journal entry, right? So then they might give you 7 or 8 or 12 journal entry legs, and you've got to select 3: debit this account, credit that account, debit this account, and so forth. Important to note there, they will give you a little indication there. Let's say they give you 12 possibilities, and they say you've got to select 3, then you've got to select 3. If you get one of the 3 right, okay, you'll get 1 out of the 3 marks. If you get 2 out of the 3 marks right, you'll get 2 out of 3. If you got all 3 right, you'll get 3 out of 3. But now if you go and tick them all, or you tick more than 3, then you get 0. Okay, so that trick is not going to work. So if they give you 12 options and you tick all of them, hoping that 3 of them will be right, you get 0. Okay, please understand that, ladies and gentlemen. If they require you to pick 2, you cannot pick more than 2. If they require you to pick 4, you cannot pick more than 4, because as soon as you pick more than the maximum number that you must pick, you get 0 for that question. How must you submit? Erasmus, I'll answer that one just now. Does that explain what you are going to have to do, ladies and gentlemen, next week, Thursday? So first of all, you're just going to write the test with the question paper, with your answer sheet. And after 2 hours, immediately after 2 hours, the online test will open, and there you do the test online. So you use what you've written as the basis for answering the questions in the test. Before I answer Erasmus's question, perhaps you can just type yes or no. Do you understand now, ladies and gentlemen, how the test will work? I will put it in writing on Friday as well. Lorenzo and Benedict, yes. How long is the online test? Do we only have one attempt? Okay, that is quite a long story. I'm going to just, thanks Millicent, understood. I'm just going to touch on it. We are totally aware that the chances or the odds that there is going to be no student who has got a connectivity problem is literally 0. There will be at least one student, possibly more students, who are going to have a problem either by losing their connection or whatever the case may be. Again, this will be detailed in Friday's email. So we're going to allow you not 3 attempts, only 2. So the one attempt, we only really want you to have one attempt, but we are going to allow you a second one, because in my opinion, I think the same as with Mrs. Moore and Mr. Borman, we're going to have many students. So we don't want to sort of overload everybody, especially ourselves that day. So we are going to allow a second attempt. But, ladies and gentlemen, if you are one of the unlucky ones, if you have a bad day and you find that you were kicked out of the test once, so you have to use the second attempt, and you are so incredibly unfortunate that you get kicked out again, then what you need to do at that point in time, not in 5 minutes time, not in 15 minutes time, not tonight, not tomorrow, at that point in time, immediately, you must send me an email. I will include my email address in Friday's email message. I'm going to be the invigilator. I said a little bit earlier, even though we're doing it slightly differently in that it's electronic, many of the principles remain the same. There's still going to be an invigilator. That's going to be me. I'm going to be the invigilator. So I'm going to walk between your desks, not physically, but virtually. So I'm going to monitor what's going on every second from 9 o'clock until you are finished with the online test. I'm going to monitor what happens. So the moment I receive an email that you have been kicked out twice, I'm going to look at your history, not your history of your life, the history of the test. And then I will be able to see for myself. I will be able to see, yes, you were kicked out once or you were kicked out twice. If you're so unlucky that you've got that problem, then I'm going to reset it. In other words, I'm going to cancel the attempts that you were kicked out, that you could not submit, and you're going to start afresh. Does that answer your questions? Mr. Borman is also going to monitor it, right? So we're going to do it jointly. We'll probably split the invigilation duties. So if you want to make doubly sure, maybe send us both an email.
I just want to add, Mr. van Rensburg, that each student should actually only have one attempt. The second one is only there for if you have a problem and you were kicked out.
Yes, absolutely correct, ladies and gentlemen. I hope you listened carefully to what Mr. Borman said. That second one is already a bonus. In an ideal world, which we do not live in an ideal world, you would have only had the one attempt. But we know for a fact that there are going to be some students with problems, so we already provide for the second attempt. But do not use it. Do not abuse it. Let me call it that. Do not misuse the second attempt or abuse it. If you have completed that first attempt successfully, do not even go to a second attempt. That might just make us angry. I'm joking. But the fact is that is for emergency purposes only. But if you really then have another problem, then immediately send us an email. We'll have a look at it. Mr. Borman and myself and Mrs. Moore will have a look at, do you have a legitimate problem? And if you have a legitimate problem, we'll fix your problem. Anything else, Mr. Borman? Thank you, Mr. Borman. I agree. Those students who answered so quickly that I expect 100% from them. Sinevuyu are going to take highest attempt or the last one. In this case, Sinevuyu, I know that in the quizzes, in the case of the quizzes, which do not count for marks, which do not have a weighting, we took the last attempt because it's a way of notifying you that you haven't done it perfectly yet. So if your last attempt isn't 100%, it means you have to go and redo it so that you learn through the process. In the case of this formal test, we are sitting with a situation that we have the possibility that 1 mark could actually be a failed attempt. So it'll be unfair on the student to say we're going to take the last attempt. There are many options. We could have taken the average of the attempts, but even the average would not be fair if 1 attempt is a failed attempt. So to cut a long story short, yes, we're going to take the highest attempt. Any other questions? There, Mrs. Moore has also answered it. Thank you, Mrs. Moore. Okay, ladies and gents, if there are no further questions, we are going to stop the recording. We've only got exactly 3 minutes of this session available. Then, we've got a class timetable in these times as well. So a next class starts at 1 o'clock, so we've got to finish quickly. Erasmus, what was your question again? Sorry, I forget now. I'll have to go back. How must we submit the assignment on Thursday? Okay, sorry, I found it, Erasmus, about the submission of the assignment, exactly where you found the assignment. You just click on the name of the assignment. I think the name is Term 2 assignment. You just click on it. That's all you do. You click on it. Then it'll ask you which files you want to upload. Then if you are using the template that we've provided, just give it a slightly different name. If you've populated that template, then you just go and search for it. And it'll ask you the name of the files, yes, and then you upload it. If you've taken photographs, then you just upload the photographs there, right? Do we have to zip the Word document? Please not, ladies and gentlemen. Please not. Do not zip it. It makes it a bit of a nightmare for us. If you zip it, it means we have to download each one and then individually open it. If you do not zip it, we can see it on Blackboard. If it's a photo or a PDF or a Word, if it's a document or a photo that you uploaded, it displays in the preview pane on Blackboard, so we can mark it very easily. So please do not zip it. If you zip it, it doesn't display in the preview pane. Then we have to first download the zip document, unzip it, and only then can we mark it. So it triples the time. So if I can please request that you do not zip the files that you upload. Erasmus, thank you. Then you understand. You just click on the name there, and it will ask you the name of the files you want to upload, and you select all of them. You can add a second, you can add a third, you can add a fourth, you can add a fifth. Once you've added all the photographs and all the documents you want to upload, then you just click submit, and we'll see it within a few seconds. Any other questions? Okay, our time has expired, so we are out of time. So I think we actually finished in the nick of time. Thank you, students. Is there anything that Mr. Borman wants to add, or Mrs. Moore wants to type there? Mrs. Moore, type.
Good morning, good afternoon, ladies and gentlemen.
Cheers all. Bye-bye. Happy writing next week.